Hi, my name is Alexandra Plum and I'm the financial advisor leading the Vincent's LifeVantage team. Off the back of the federal budget and the report recently handed down by the Senate Economics Committee, there's been much debate within the superannuation industry surrounding the bill containing the measure to impose an additional tax on superannuation balances over $3 million. It's often referred to as the Division 296 tax, as the bill proposes to include the new Division 296 in the 1997 Income Tax Assessment Act. I'd like to highlight how this proposed legislation will impact individuals who have received structured settlements and have contributed this into superannuation, or those who have received a successful total permanent disability claim via their superannuation fund. Division 296 legislation, which is proposed to take effect from 1 July 2025, aims to reduce the tax concessions available to individuals with substantial superannuation savings, specifically those with a total superannuation balance exceeding $3 million. The intention is to ensure a more equitable distribution of tax benefits within the superannuation system. Until recently, the $3 million threshold was not due to be indexed. Having no indexation meant that over time, as superannuation balances grew due to investment returns and contributions, more and more individuals would find themselves subject to this tax. However, an amendment to introduce indexation to the $3 million cap was moved by the House of Representatives on the 15th of May. I think it's important to take an overview of how this tax is calculated. Step 1 is determine the increase in the total super balance of the individual during the financial year. This increase will be treated as the total earnings of the individual for that year. The earnings are adjusted for any withdrawals, pension payments, and contributions made during the same year. Step 2 is to determine the amount of total earnings which is attributable to the portion of the super balance in excess of $3 million. And the final step is to apply the 15% tax rate to the amount of total earnings attributable to the super balance in excess of $3 million. It's important to note that any losses can be carried forward to offset future earnings, providing some relief in fluctuating market conditions. Division 296 tax is also a personal tax, meaning the individual, not their super fund, are liable. However, individuals can opt to pay this tax from their superannuation if they choose. Individuals who receive a structured settlement and choose to make a personal injury contribution into superannuation are exempt from Division 296 tax. This is because these contributions are designed to support individuals who have sustained significant injuries and need long-term financial support. The tax exemption ensures that these individuals are not further burdened by the additional tax on their superannuation earnings, recognising their unique circumstances and financial needs. Individuals who have been approved to receive a total permanent disability insurance proceeds or other insurance proceeds via superannuation may be impacted by Division 296. Total permanent disability proceeds are excluded from the calculation of adjusted total super balance in the first year of receipt. However, where the proceeds are retained in the super fund in subsequent years, the amount will be subject to tax, including any unrealised gains made from those payments. The reason behind this treatment is to ensure that while the immediate financial support is tax exempt, any long-term growth on these proceeds within the superannuation system is treated like any other superannuation earnings. It might be beneficial for some individuals in this scenario to withdraw their total permanent disability proceeds from super in the year they are received, in order to avoid being caught up by the Division 296 rules. Some clients might consider moving funds out of superannuation in order to avoid the tax. However, this decision is not a simple one. Superannuation remains a tax-effective investment vehicle, even with Division 296 tax. The concessional tax rates within super may still be more favourable compared to other investment structures over the long term. Additionally, moving assets from super may trigger significant capital gains tax and other selling costs. We also need to consider that some individuals cannot withdraw funds from their superannuation just to avoid this tax. They need to meet specific conditions of release. This includes retirement, being permanently incapacitated, or turning 65. The take-home message for clients that are likely impacted by this legislation is do not act hastily. It will be important for them to seek professional advice and conduct detailed financial modelling to make an objective decision based on their specific circumstances. They should be better positioned to make a more informed decision closer to 30 June 2025. The Better Targeted Superannuation Concessions Bill, which includes the proposed Division 296 legislation, is still pending passage through Parliament. On the 10th of May, the Senate Economics Committee recommended no changes to the proposed legislation, indicating some political support, but also some contention. The government also made no mention of it in the recent federal budget, other than to set aside some money to help implement it for members of the Commonwealth defined benefit schemes. Currently, the bill continues to be debated in the House of Representatives. While the government has the numbers in the House of Reps, the bill is likely to encounter some opposition in the Senate. The government will need the support of the Australian Greens and at least 2 independents in the Senate to support the bill. On a final note, we need to keep in mind that the majority of our clients are unlikely to be impacted by the proposed legislation, as they're never going to have superannuation balances that exceed $3 million. However, for those potentially affected, understanding the mechanics of this tax and considering long-term financial strategies is going to be crucial.